welcome to this joint seminar hosted by Safri and Perspective. Today we'll be exploring the upcoming changes to the inheritance tax treatment of pensions and discussing the key considerations and planning opportunities that you may wish to think about ahead of those changes taking effect. We're bringing together expertise from both sides. Safri, from a tax perspective, and Perspective themselves will provide insights from an investment and financial planning perspective. Together, we hope to give you a well-rounded and practical overview of the issues that are involved. The session itself will last around 40 minutes, which should leave plenty of time for questions at the end. Thank you to those who've already submitted questions in advance. We will pick those up as part of the Q&A at the end. If you have any questions during the presentation, please submit them via the Q&A function at the bottom of your screens. I'll be keeping an eye on them through the session, although, as I say, we will address most of them during the Q&A at the end, just to make sure that we get through the planned content. Before we begin, I did just want to note that the webinar is intended just to be for general guidance and information only, and it's in no way a substitute for professional advice tailored to your specific circumstances. If you would like to discuss any aspect in more detail, our presenters are delighted to arrange a follow-up conversation. Finally, please be aware that this webinar is being recorded, but only the presenters themselves will be visible in the recording, and a copy of it will be shared with you after the session. So finally, thank you for joining us, and I'll now hand over to Andy from Safri to start with the presentation.
Good afternoon, everyone. Good to meet you. I hope you're keeping cool or enjoying the weather, whichever way around that is. And so I think I'll start off with a bit of a spoiler alert. You know, there's going to be no silver bullet here from a tax perspective. The reason this webinar has been so popular, because we can see from the numbers, and it's been a hot topic with a lot of our clients, is because people don't really know what they're going to do with the changes coming up and things are still moving. But hopefully we'll be able to just go over a few of the ideas we're doing with our clients and some of the things at least that you should be thinking about. So if we move on to what we actually think that what the changes are actually going to be. So as we sit here today, pensions are exempt for inheritance tax. So if someone was to die between now and the 5th of April 2027, their pension is not going to be subject to inheritance tax. The change, therefore, is coming from 6th of April 2027. So from the 6th of April 2027, pensions will be falling into individuals' estates for inheritance tax purposes. This means that they can therefore be subject to inheritance tax at up to 40% potentially. The only transfers that will be exempt will be to a spouse. So if you're married, your pension can still transfer to a spouse tax-free, or potentially if you're thinking of leaving your pension to charity. All of the pension amounts that are unused will be falling into your estate for inheritance tax. So this is clearly, a very big seismic change. So just moving on. So I want to make sure we went through what hasn't changed. So this is looking at the inheritance tax changes mainly for this webinar, but for clarity, pensions are still a tax efficient way to invest. You still get your income tax relief when you contribute to pensions. Pensions themselves can still grow and invest in a tax-free environment. You can still get your 25% tax-free lump sum. That's not been changed. And the whole strategy around pensions in terms of you putting the income into your pension at a higher rate and taking the tax relief, but then the strategy of drawing it down later in life at a lower income tax rate still holds. We're not going to get into the detail on this these slides, but also if you were to die before the age of 75, pensions can be withdrawn by the beneficiaries income tax free. If you were to die after the age of 75, pension withdrawals are subject to income tax on the beneficiaries. That is separate to the inheritance tax position. And again, these are the points that haven't changed. So if we go on to what this means, so this is a very, very big change for a lot of our clients. I have clients who've been putting money into their pensions for 20 to 30 years on the understanding that these pensions would be IHT free. We're now in the situation where suddenly they now from 2027 will be subject to inheritance tax. So this becomes with a change in strategy. People now looking at these pensions, realizing that these are not a last pot to spend. Clients were even using pensions as a way to transfer, if they could, to transfer funds to their children inheritance tax free. And now this is not the case. So this means rethinking how you're going to use your pension, whether you need to use it, whether you want to draw down it, how you're going to leave it to beneficiaries. And that comes with joined up investment and tax advice. So we can provide the tax advice, and we've got Perspective on here who can provide investment advice, but it is definitely going to be a joined up strategy in terms of what we have to do. So in terms of sort of the planning considerations, like I said, there's going to be no silver bullet. There's going to be a few things we're going to go over that we're talking to with our clients. And it'd be good to share with you so you can understand what that conversation is. But there's going to be no one size fits all. Like with the best tax advice, it depends is usually the answer. But I think if there's a few things here you can take away, you can at least start to have those conversations and just be aware of what other people are doing. So one of the main first things to look at is sort of how you're going to plan withdrawing from your pension. So like I said, if the pension is moving from previously being completely IHT free, a lot of my clients were using it as a pot in that way. They were just piling money into there if they could and seeing that as an IHT pot to pass on a nice nest egg to leave. Now it's going to be subject to IHT at up to 40%. That does change the mindset in terms of what we're going to do. So this is kind of, we call it the rearranging the deck chairs in terms of where you draw your income from, or as one of my clients calls it, sort of directing the traffic. So where am I do I now need to think about drawing down for my pension? If that now is going to be an income source, something that I'm going to draw down on, well, maybe I don't need income from other assets. So now I'm going to turn on the tap of my pension. I don't maybe need to hold my rental properties. I don't need to take out dividends from companies, that sort of discussion. And that means you sort of shift the conversation around inheritance tax. I'm going to draw down my pension scheme to reduce an asset that will be subject to IHT from 2027. And I'm going to start, therefore, planning with other income assets for inheritance tax, which might have a bit more freedom to move around, depending on your personal perspective. And so after the plan withdrawals conversation, which you sort of talk about with your investment advisor, the one that I'm sure you're all aware of is gifting. So considering about how you can decide to transfer wealth to the next generation using your pension pot. Hopefully you're all familiar with the general IHT rules, but again, we're not part of this presentation, but we can pick up separately with you if needed. So broadly, you can make gifts to people and you're subject to the 7-year clock, i.e. if you make substantial gifts to people and you die within 7 years of making that gift, you're subject to IHT. So can you draw down large pension sums and make that gift? Other ways people are doing it is, and we still see people who are not aware of this, is the gifts out of surplus income exemption for inheritance tax. So broadly speaking, inheritance tax is a tax on your capital. It is not intended to be a tax on your income. So if you can show that you are taking sufficient income, that once you consider your expenses, your holidays, everything during the year, including the tax you have to pay, if after a certain period of time, during usually every tax year, you literally have surplus income, your bank account has gone up after the tax year, you can therefore gift that surplus income to beneficiaries or other individuals completely exempt from inheritance tax. This if it's done as regularly as well, it is a really good IHT relief. So some of my clients are thinking about, again, turning the tap on from their pension, drawing it down so that they do have this surplus income and gifting it. There's a conversation there in terms of, well, actually, is that overall tax beneficial? Because by drawing down the pension, you are paying income tax. So you're paying income tax to avoid an IHT point, but depending on where you sit in terms of your income levels, it is a really good way to think about how you might start to transfer your wealth from a pension to other people. The other point here is that gifts out of surplus income don't necessarily have to be made to individuals. They can be made to trusts. So some of our clients are reluctant to give money to their children or grandchildren because they don't want them to go off and spend it, buy a Lamborghini, whatever they might do with it. So they like the idea of gifting it to a trust because the trust can still be controlled by them and managed to especially for grandchildren, and to pass that wealth on now. This gift out of surplus income can still be used to be made to trust, which is really useful. And a lot of our clients are considering doing that with their pension income. So moving on to another thing that our clients are considering doing is looking at the pension pot to actually fund an IHT liability. And so there's two ways to think about this. One is an acceptance of the IHT position of the pension, recognizing that unfortunately the pension is going to be subject to IHT, but it is a pot that I will use to fund all my IHT. It's not the best tax planning, but it is very simple. It is a recognition that, right, my pension is going to therefore be needed to fund all my IHT. And for people with large pension pots, this may be an option to make things very simple for you. The other thing that some clients are thinking about is actually, well, if I could draw down the pension to reduce the balance of my pension, and this for me is surplus income. Maybe I'm not going to gift my surplus income, but I'm going to use that income to insure my IHT liability. So turning on the tap of my pension to provide an extra level of income, which I then use to buy an insurance policy to insure against my IHT liability. We find this is much better for clients who are a bit younger, so sort of late 50s, early 60s, where IHT insurance is still going to be, cost effective for them. But again, it's sort of another way of thinking about how to use the income you can receive from a pension and the sort of conversations we're having. So consideration about how you manage business property relief, and this sort of links back to the moving of the deck chairs or the, directing the traffic. Before these changes come in, IHTs are, pensions are IHT free, so they were great places to put your funds. Now they're going to be subject to up to 40% IHT. Why am I going to just leave that to be subject to IHT, an inevitable IHT cost to me? Instead, actually, if I've got assets that qualify for other IHT reliefs, and the most common we see is private business property relief or agricultural property relief if you have farms, but business property relief is generally speaking for my clients, people who have shares in trading businesses, or maybe they have a sole trader business. Rather than deciding to take income from those business property relief qualifying assets, so drawing dividends, for example, and that's what they rely on income, you could turn off that valve and start replacing that income from your pension. So what you're doing is you're drawing down and reducing your IHT liability on your pension, whilst then not taking money out of, for example, a company and taking dividends out, which reduces the value of your company. So you're trying to, as long as you manage it properly, as long as you don't make sure you lose the relief entirely, it is sometimes better for you to keep cash inside a company that qualifies for business property relief and rely on your income from a pension rather than take money from your company that is essentially getting a business property relief and IHT relief on top. This has been really popular with a few of my clients who even to the extent whereby they're actually starting to put more money into their businesses. Some people even like the idea of putting preference shares into their business, starting to lock away more money into their businesses where they know they get business property relief. Now, if you're familiar with the tax landscape, you'll know that business property relief and agricultural property relief have gone down in their sort of benefit. The 100% relief now only applies to £2.5 million of value, with 50% relief on any value above that. However, that is still clearly a better IHT position than your pension, which has no relief whatsoever. Taking that a step further, and this is definitely an investment decision, this has always been a bit of planning for some people in terms of looking around in the market and seeing, what other assets could I invest in, which do have the benefit of this business property relief for IHT purposes. So, as I already mentioned, an existing business, maybe friends, family, and then SEIS, EIS shares, or AIM shares. They come with their own risks. They should absolutely be looked at from an investment perspective. And we always talk about tax tail not wagging the dog, but at least if you have an awareness that these things are out there, you can consider them as part of your strategy. So moving on. So we want to make sure we cover this because we know this has been quite popular with people who have private companies or often family businesses. It was very common planning for people to put their commercial property into a pension scheme. It was really good planning. Commercial property in the pension scheme, IHT free. The commercial property is rented back to a business, so it created an income, tax free in the pension scheme. And so it built that really good pension pot for our clients. This has kind of been turned on its head now because now that pension pot is going to be subject to IHT. So some of our clients are thinking, well, actually, do I need to think about reversing this? I now have an illiquid asset in my pension scheme. I can't distribute bricks and mortar from my pension scheme. How do I get access to those funds? And to do the planning we've talked about on here in terms of making sure I draw down on my pension. So some clients are thinking about reversing this. This is careful consideration, but the sale of the property in the pension can hopefully be done tax-free. It can then have a liquid asset, i.e. it swapped the value of the property for cash. So you can then start to draw down the cash or do all the other planning ideas we've covered in this session. It's not entirely tax-free for everybody because there has to be potentially SDLT on the purchase of those properties. So it's not, a panacea. Again, it's not a silver bullet, but this is something that our clients who are in this situation are thinking of doing and taking advice on. So I think in terms of the next steps for anybody who's worried about their IHT, we've still got, 9 months. There's a lot of time to start thinking and planning. The legislation could still move. When the changes to business property relief came in, there were changes coming in even only a couple of months before. However, I think if you just want to sort of change about how you think about these things, some of the topics we talked about here is, do I need these pension funds for retirement? Am I drawing from the right pots? That moving the deck chairs, directing traffic. Where do I want this pension pot to go if IHT is going to be a problem for me? Should I be thinking about gifts out of surplus income? And generally, do I need liquidity for my future IHT liability, and how you can plan for that? And so I think finally, there are a few key takeaways from this. So pensions are no longer, if you just move on, thank you. The pensions are no longer a default IHT shelter. Like I said, I've had clients who were trying to push more and more into their pension fund because it was an IHT nest egg. No IHT, fantastic way to pass wealth on to the next generation. That is no longer the case. This is going to be a bit of a cliff edge for a lot of clients. Drawdown strategy definitely needs reviewing. This was often going to be a part that some of the clients I was talking to were not even going to think about touching whatsoever. They are now starting to do that and considering how they do in terms of taking out lump sums, how they then decide to actually factor in the income from the pension scheme to fund their lifestyle. This is absolutely going to be joined up planning. There's going to be tax advice and investment advice needed, looking at maybe your cash flows and how you're going to plan for both IHT and income tax for individuals. So therefore, this is bespoke advice. This is advice whereby you need to make sure your awareness of what's going on. And it's not just pension things. It's going to be your family members. It's going to be how maybe the holistic advice in terms of what you're doing with your businesses and other matters. So that hopefully is just a very quick run through and a good flavour of the sort of things we're talking to our clients.
Thanks, Andy. I just wonder whether we've had a couple of questions that are maybe points of clarification. So I know we said we'd do questions at the end, but perhaps I can put a couple of these to you now, if that's all right. So
yeah, of course.
One in connection with the BPR points around leaving cash in the business. So just a bit of clarification around whether that restricts, I think you said a little bit about it, that restricts the proportion of the business on which BPR applies.
Yeah, so that's why you need the advice on it. So we have clients who take out very ample dividends every year. You have clients who take small dividends every year. There is a restriction whereby if you have surplus cash in a business, that can impact your business property relief. But there are ways to structure your business or structure the way your group manages cash to make sure that those assets don't impact your business property relief. So you're absolutely right. There are things, bear traps to watch out for, but with the right advice, you can make sure it works.
Thanks, Andy. And then another one that's maybe a bit more clarification in terms of the pension, the point you talked about around the pension pot to fund IHT, and ask as to how do you actually go about doing that?
In terms of drawing down?
Yeah.
So in terms of the two ideas with that, one is that the pension pot is just going to be left to beneficiaries and that is used, it's just a big cash lump sum, netted IHT, the funds are still there to pay off other IHT liabilities. It is a savings pot for IHT. The other idea is that some people are considering actually drawing down the pension scheme to create extra income, which they can then use to pay for an insurance policy.
Thank you. And then final one, in terms of the gift from surplus income, is that in addition to the £3,000 gift? That's the question.
It is in addition, yes. So every year you have an annual £3,000 allowance, but that is for gifts that aren't surplus. So surplus income, if you qualify, regular gifts out of surplus income are entirely exempt from inheritance tax.
Fantastic. Thank you. There have been quite a few other questions, but I think we'll pick the rest of them up at the end. So with no further ado, I'm going to pass over to Andrew from Perspective.
Thank you very much, Susanna, and thanks very much Andy, I'm actually going to start with a question that was asked of me earlier today, which is, in a fairly extreme scenario, after the April 2027 changes that Andy has talked through this morning, could a pension potentially be subject to inheritance tax, and then the beneficiaries be subject to income tax at higher or additional rates? And the answer is yes, it's a feasible scenario that a pension could end up being subject to inheritance tax on one person and then significant amount of income tax on another person via different taxation regimes on different people. And that really puts into focus the importance of this matter and why it's so topical. So as Andy started with, Safri are looking primarily at the taxation side of things. We are independent financial advisors. I'll give a brief introduction to ourselves and the firm in a moment, but I'll be covering a lot of the same topics that Andy covered. There's quite a bit of repetition here, which I think is important for a fairly technical subject like this. But I'll be looking more along the financial planning considerations and that kind of angle for forward planning, what we can potentially do to structure things in such a way that we're efficient. A couple of things that Andy mentioned that I'd like to reiterate. I don't have a silver bullet, I'm afraid. Independent financial advice really will be important moving forwards. And I absolutely agree with Andy's comment that we don't let the tax tail wag the dog. And I think that that's really important as we move into this new regime next year, where tax will be at the forefront of everybody's minds. But there are a couple of reasons why I don't want tax to be absolutely central to all financial plans, because there are other things to consider, importantly, including investment risk and potential for long-term care and individual cash flow needs. So who we are, Perspective are a national firm of financial advisors. We have offices UK-wide. I represent Perspective Northwest Limited. I'm a financial planner with 25 years plus of financial services experience, covering bank assurance, restricted advice and independent advice, which is where I intend to remain. Core values for our firm are on the slide that Susanna just showed there. Feel free to have a look through. The key part of this is we are client-centric. Everything is individualised. My personal specialisms include long-term care planning and retirement planning for, but not restricted to, aviation professionals. So what I would like to emphasise, moving on to our objectives, please, Susanna, is really the scope of the 2027 changes in relation to pensions and IHT, meaning inheritance tax, and the financial planning options that might be available to you. So hopefully within the next 20 minutes, we'll have a bit more of an in-depth understanding of the legislative landscape and how it will change in April next year. I'd like to help give you an overview of some of the financial planning options that might be available to you and the way in which probate and that exercise might change following the inclusion of pensions into the estate. And I'd like to look really at what might trigger the need for you to take professional advice from financial advisors, accountants, and solicitors. This is going to be really a joined-up affair for a lot of clients. So the next slide looks fairly busy, but it's quite important. It's on there. I'll summarise as briefly as I can. Really, we need to think about what's changing and, importantly, what isn't changing next April, so that we can be absolutely certain around the reasons why we're undertaking potentially new financial planning here. And the key point is that at the moment, pensions that are unused, discretionary pension funds that haven't yet been drawn, are not part of a deceased estate for inheritance tax purposes. However, from April 2027, they will be, and the tax rate, as we know, is significant. The income tax treatment isn't changing. Death in service benefits are not changing. Tax-free cash is changing to some extent, in that the tax-free cash entitlement is still there, but if you don't draw the tax-free cash and it remains within the pension fund, that pension fund and therefore that tax-free cash entitlement will potentially become subject to inheritance tax. There is also an impact on death benefits around tax-free cash, which I'll come on to at age 75, and something to consider. The order of spending your personal assets really comes into question now. So I think Andy mentioned we historically would use pensions as a kind of last line of defence in terms of providing retirement income or care fee income. It really now needs to be considered whether or not pensions should be spent down in a more of a controlled manner, or if it's still appropriate for them to remain the last resort for spending. That's very much individual. Lifetime gifting haven't changed. Business relief, agricultural property relief have had recent changes, as have AIM shares, alternative investment market shares. And something to highlight on the bottom two sections, the risk level is really important. So not letting the taxpayer wag the investment dog is absolutely essential if we are looking at options such as business relief, qualifying shares. So why should we start planning now? Well, we should start planning now because the earlier we start, the more efficient we can be, really. So we're already involved with a lot of pre-2027 planning with clients. There aren't clear black and white answers that apply to everybody, but we really need to think individually how the changes will impact us next year. So, for example, will the inclusion of unspent pensions into the estate calculation lead to a loss or a partial loss of the residence nil rate band? Is the will aligned with the pension expression of wish? So, as an individual, do you want the estate and the pension to go to the people that they're currently nominated to go to? Is that really your intention now, or should that be reconsidered? We need to think about pre and post 75 death benefits in a little more detail, because very broadly speaking, which I'll clarify a little bit later, if you die before the age of 75, any unspent pension monies can be left to beneficiaries without deduction of income tax. After the age of 75, any unspent pension monies that are inherited by beneficiaries will be taxed at their marginal rates. There is a potential sidestep with this depending on how you nominate the pension benefits. So do you nominate them to be paid as a lump sum? Do you nominate them to be paid via a beneficiary drawdown pension, as an example? Does the product allow you to do that? There's a fundamental difference to the potential taxation of large unspent pension death benefits post 75, depending on what the pension product that you hold can do. So it's absolutely imperative to review that. Moving on to what we see at the moment, pensions at the moment are a very valuable wrapper for saving towards retirement income. Sorry, Susanna, just back one, if you don't mind. So if we are using a pension to accumulate wealth that will then help us to survive throughout retirement or enjoy a comfortable retirement, then pensions absolutely are still an appropriate vehicle to do that. They give us tax relief on the way in. And if you can optimize the tax relief by obtaining higher or additional rate tax relief on the way in, and then becoming subject to zero or basic rate tax on the way out, that's absolutely great. That's a very efficient way of saving for retirement. The growth of the assets within the pension are tax-free. The 25% tax-free lump sum still exists up to a limit. Employer contributions into pensions are still not chargeable to national insurance for employers or employees up to annual allowance limits, although we are expecting to see some change in that in coming years. There's a very wide range of investments that you can access within a pension wrapper. And the death benefits before the age of 75 are still very efficient up to the level of the lump sum death benefit allowance. Now, the detail of this is a bit too heavy for my remaining 10, 15 minutes today, but suffice to say, you can potentially preserve more than the level of the lump sum death benefit allowance to beneficiaries on death before 75 if the product allows the designation into income strategies such as drawdown rather than just payment of a lump sum. So again, if I can just reiterate, the actual product that you hold, the pension provider that you're with needs to be assessed to ensure it can do what you intend it to do. So from an individual point of view, what do we do now? Just moving on, please, Susanna. We either accept things as they are. Now, I have clients that are consciously accepting things as they are. Absolutely fine. There's no right or wrong with this. Or do we maximise our planning rather than just simply allow HMRC to be a major beneficiary? It's up to you, and it's very much an individual choice. We understand that this is still quite early, and as Andy said, legislation may change. However, we can see the direction of travel. We know that this is due to be implemented in April 2027. A lot of people would like to be as tax efficient as possible, so we'll help wherever we can. To start with that journey, we need to ask ourselves certain questions on the next page, please, Susanna. And the main questions are, do the death benefits on the plans align with your objectives? So that's a really important fundamental question. Does your pension provider and product allow you to do and pass on the pension benefits as you want them to be passed on? If not, is there value in potentially switching that pension? We need to be careful about doing so, but it's absolutely possible and something that you should take advice on. How are your income tax bands and potentially your beneficiaries' income tax bands going to be managed now and in the future? I think more emphasis now needs to be paid on remaining basic rate tax band and whether or not pension withdrawals are more feasible now than they potentially were. Have you maximised other gifting allowances? Can you afford to make gifts? Should you be considering capital gifts or gifting regular income that's surplus to requirements? When are we planning to take the tax-free cash? So, for example, if you take that tax-free cash during your lifetime, that 25% tax-free amount will come into your estate right now, which is potentially taxable. However, after April 2027, it's potentially taxable within the pension anyway. If you die after the age of 75, your beneficiaries will pay income tax on anything that they inherit from the pension. They can't inherit your entitlement to that 25% tax-free lump sum. So there is a consideration about whether or not you deploy that tax-free cash strategically, even if it's not necessarily required for you. Illiquid assets in a pension could present some difficulties. So if you have properties or unlisted shares, things that are not easily realizable within the pension, is there a plan in place for realizing the value? Will you need to realize some liquidity, whether it's to pay for IHT or indeed to pay for your own retirement income or beneficiaries' income and capital needs? Does liquidity need to be created within the pension? Just moving on, please, Susanna. Does liquidity need to be created within the pension, potentially even to pay IHT? So, assuming somebody dies, there is typically the legal process required to prove the validity of the will and to authorise the executors, personal representatives, to deal with the assets in the estate, to deal with closure of accounts, to deal with sale of shares, assets, etc. There is a complexity there that pension scheme administrators don't need a grant of probate because the pension isn't an asset of the estate, but they might need to pay some inheritance tax. So what difficulty and complexity will that create now for personal representatives who are handling the estate administration? I would say it's complicated. The responsibility for inheritance tax will be split between personal representatives and pension scheme administrators, or the responsibility to pay that inheritance tax can be shared with the pension scheme administrators. So for that reason, personal representatives will be able to instruct pension schemes to withhold up to 50% of a beneficiary's entitlement for up to 15 months to give some liquidity and some reassurance that the money is there within the pension to pay the pension share of the IHT if necessary. It's going to be an incredibly complex exercise for personal representatives to deal with. And if I just jump onto the deadline page next, just to illustrate how that will work. Typically, IHT needs to be paid 6 months after the 6 months after the death of the individual, but towards the end of that month. I've explained that terribly, but the wording is somewhere in there. Susanna's nodding. 6 months or just over to pay the IHT after the death of an individual. So the timeline is very tight. Personal representatives will need to immediately deal with the post-death matters. They'll need to liaise with accountants, solicitors, potentially financial advisors. The pension scheme administrators have 1 month to confirm the benefit amounts within the pensions, and then the personal representatives are collating all of the information, moving on to a full valuation of assets, establishing remaining lump sum death benefit allowance for the deceased individual, any relevant protections, proving the will, determining the tax liabilities, and then settling the tax bill. I mean, that is an awful lot of work that now will need to be done, especially with the involvement of pension scheme administrators. So what new risks really does that challenging deadline on the next page, Susanna, create for personal representatives? Well, the main one is, how do we know that we have identified all of the deceased individuals' pensions? There is a plan for a government-led dashboard, but it's not available yet publicly. And a government-led dashboard is designed to collate personal, workplace, and state pension information into one place. And I think the expected rollout is later this year, start of next year. But will personal representatives be able to access the government dashboard that belongs to the deceased individual? We don't know. I don't believe there is a plan in place for that. So do you have a process individually for storing all of your pension details? Is a consolidation of pensions something that we should be actively considering now to simplify matters, not just during our own lifetime, but also on death? Just moving on, another key issue really around the challenging deadline is liquidity, something that I mentioned before. So both within the estate and now within the pension, there should really be a greater emphasis on liquidity. And if a pension scheme is holding commercial property, as an example, or unlisted shares, how quickly could they be liquidated to pay for inheritance tax? Slightly tongue-in-cheek, but it does say here HMRC is unlikely to accept part of a commercial property as payment for IHT. It becomes a bit more complicated where a pension is a part owner of a property and the other partial property owners don't necessarily want to buy or sell. Could even be more complicated if the pension scheme has borrowed money that needs to be repaid. If there are unlisted shares within a pension, can we actually dispose of those shares at fair value? Will the pension arrangement allow for beneficiaries to inherit within it? So there are an awful lot of questions around liquidity. There is a rule that an under 75 or a pre-75 death sees their pension paid out to beneficiaries without deduction of income tax. However, there is a restriction that the pension benefits need to be distributed within 2 years. So that should be taken into account as well when we have potentially illiquid assets within the pension. So to give an example of what the new world might look like for what we would call a typical client on second death, if this client had £1 million worth of estate assets, i.e. non-pension assets, and their spouse had predeceased them, we would typically expect that person not to have an IHT liability because of the combination of the 2 nil rate bands and the 2 residence nil rate bands. Now, there are restrictions here. This assumes certain things such as ownership of a main residence and direct descendants being beneficiaries. But on the face of it, we would expect a £1 million asset on second death of a married couple not to be subject to inheritance tax at the moment. And therefore, if there is a £500,000 unspent pension alongside the estate, that would be passing as well without the deduction of IHT. However, moving forwards, that addition of £500,000 into the estate calculation is going to mean that £200,000 worth of IHT needs to be found. So that could be split, a third towards the pension, 2/3 towards the estate. What if the assets within the estate are illiquid? What if the assets are within the pension are illiquid? Could we use insurance to help with provisioning for this IHT? So whilst it doesn't mitigate necessarily, obtaining life insurance that's held in trust and paid out outside of the estate is potentially an option that could be looked at to provision for the IHT and allow the actual assets to pass on. So that brings us on to what financial planning options and levers we might pull. Cash flow modelling is absolutely essential. So we're talking very much about tax liabilities here. Tax liabilities should be mitigated provided that's not at the unknown cost of personal sustainability. And personal sustainability is absolutely key. A cash flow model should show us, with stress testing, on a worst case scenario, how much money we need in the future, how much money we have, and whether or not we can really afford to gift any assets away or fundamentally mitigate IHT. And sometimes at the end of that cash flow modelling exercise, the answer is no, we can't afford to mitigate IHT. We just have to accept that it's potentially going to impact us as a family. And on occasions, cash flow modelling can show really we've got significant scope to be able to gift and or mitigate IHT in other ways here. Once we've done cash flow modelling, if there are options available to us to mitigate IHT, we need to think about our death benefit planning, who gets what and from which assets our beneficiaries are going to receive. Potentially, we can look at swapping assets. So if assets are more efficient inside or outside now of the pension wrapper, we should be considering that as part of our holistic financial plan. Liquidity planning, as I mentioned, becomes more apparent post-April 2027 and having actual cash available to us. And we should consider potentially, and Andy mentioned this earlier on, the maintenance of business relief qualifying assets, potentially even new investment into business relief qualifying assets, with the huge caveat that risk should be considered. This is not just a case of trying to move things into a more IHT efficient environment. It's also a consideration about whether or not we have the capacity to actually accept that investment risk. So what questions and issues we can potentially rule out via effective planning, please, Susanna? Some questions revert to what ifs. What if there is insufficient liquidity in the pension? Where does the money to pay the tax come from? What if we can't get in touch with the beneficiaries, or if beneficiaries are overseas? Could there be challenges to the will? What if income tax has already been paid? What if the 2-year rule is being pushed, and what impact will that have? What if a pension is discovered later on after the administration of the estate that then skews the calculations that have been done? So what if we actually can't find all pension information? What will the deed of variation look like? Do we need to think about revising our expression of wish on pensions? And what if the pension products don't offer flexible death benefits, as I mentioned earlier? So there are plenty of questions that I would suggest you need to revise. Everybody should revise with their financial planner and or accountant at the moment. So bringing me on to a wrap up, Susanna, really those what if questions precede the options that we anticipate to be available after April 2027. And the options really that we anticipate needing to consider in depth are a plan to consider your financial needs, not just for now, also for the rest of your life and post-death, and to consider reprofiling assets or rebalancing assets as needed. To have a plan, and to have a plan really includes maintenance, consideration of any IHT reliefs that are available, such as business relief, agricultural property relief, annual gifting allowances, gifting from surplus income, if possible, should be considered. Is insurance an option? Is insurance feasible? Is it a viable option for you in your health circumstances? Would it help provision for the IHT? Can you afford gifting? Coming back to cash flow modelling, is gifting a viable option? What is the interaction with income tax? So by gifting pension benefits or other assets, what is the subsequent impact on yours and or your beneficiaries' income tax liabilities? Very complex area. What are your long-term care needs, and what if your assets don't perform as expected? What if there's a stock market crash or a property market crisis? Once we have a plan, I would encourage you to carry out the plan with professional advice. Review is absolutely essential. Is IHT payable? How will the IHT be paid? What if death happens now? So a final summary, the options that are available to us: understand the problem absolutely essential. And please complete a cash flow model with the assistance of a financial planner. Once we have a plan, including a do nothing plan, then great. Maximising allowances is an obvious, using exemptions is an obvious, spending the kids' inheritance tax, so ski holidays, slightly tongue in cheek, but ski holidays are absolutely an option. Spending more money can help to mitigate IHT. Should you insure, should you annuitise, should you swap pension capital for guaranteed income? Should you gift? If you gift, are you happy for your beneficiaries to receive the money, or do you need the protection of trusts, for example? Considering the beneficiary's needs when cascading wealth down the family is obviously important, and then business relief and agricultural property relief should be considered. That is not financial advice. I'm conscious that I've overrun slightly, Susanna, on my 20 minutes, but it's still a whistle stop of a huge subject. Our overarching risk warning is that nothing in this presentation should constitute financial advice. There are no clear-cut answers to what will be an everlasting problem, but hopefully with professional advice there are plenty of options available.
Fantastic. Thanks, Andrew. So I think we're going to turn to a few questions, of which we've had many. So if we don't get through them all and we don't get to your question in particular, I do apologise, but we will follow up and we will pick it up with you directly, specifically. Maybe if I start with Andy, give you, Andrew, a moment just to take a breath and pause. Andy, we've had a few questions. You might think you're being asked to crystal ball gaze a bit, which I know is always tricky, but a few questions around what might be happening. So if I could start perhaps with the chances of the tax-free allowance of 325,000 being increased to compensate to some extent. Any thoughts on that?
So unfortunately, Susanna, the answer to all of this is going to be I don't know. If I did know, I would definitely put a bet on and make some money myself, probably switch to IHT in the future. We just don't know, the changes to government, whether for what's going on at the moment with the Labour government, or who knows what's going to happen in 5 years. These things do just do change. It's hard to crystal ball. What we do with our clients is you act on the information you have here and now. If you know what's going to happen, you plan based on the rules, you do the best you can with what you've got in front of you. And then that means you can't be subject to any changes, because very, very rarely do we see governments going back and grandfathering and saying, well, actually, we're going to go back and change the rules. If you do something now, that should be set in stone.
That's great. Thanks, Andy. Andrew, then one for you. We've had a question around the implications of the changes in the specific context of public sector pensions, and whether you could comment a bit more on that.
So you would expect, and we would expect, obviously, I don't know the individual circumstances, but any public sector pensions that are already in payment, we would expect that those not to be subject to inheritance tax on death, any spouse's benefit, for instance. But defined contribution pots, so actual pots of unspent money within pensions, absolutely, we expect them to be included. But to caveat, there are many different types of schemes and pensions available, so you need to double check.
And then we've had a couple around annuities. I suppose one, are you anticipating an increase in the take-up of annuities as a consequence of these rules changes?
So I think that's more for myself. As financial planners, we actually use annuities and always have used annuities where it's appropriate for clients, because an annuity is a guaranteed lifetime income. Many people need an annuity and many people don't. And the answer to that comes out of an individual assessment, really starting with a cash flow model and determining what your income and expenditure needs are, both now and for the future. So we use annuities. We have always used annuities. I do read in the press about the popularity of drawdown as a retirement vehicle, but absolutely we expect to continue to use annuities, but we never actually stopped. So a lot of discourse is around pensions being used as an IHT saving tool. Well, first and foremost, we look at what an individual needs to support their own retirement, and if the pension is surplus to requirements to any extent, absolutely, it has been and still currently is an effective IHT saving tool. But we've never used annuities or drawdown plans purely for IHT planning. They are a retirement income tool and continue to be. Do I expect annuity purchases to increase as a result? Possibly, but I would also expect life insurance to increase as a result. I would actually expect just financial planning in general, and particularly ongoing financial planning, to increase as a result. One of the dangers, obviously, of purchasing an annuity if the income isn't required is that the capital actually could be extinguished regardless. So very much individual planning needs here.
I've got another one for you. I'm going to keep you busy. The advice today has been to leave crystallised pension pots alone and to draw down from ISA funds only until it becomes necessary, and then pension pots to be brought into use. How does the new rules change this policy?
I absolutely can. I'm not trying to be evasive on this. I absolutely can imagine that advice for some people has been to leave a pension until last and draw down ISA funds first, leaving pensions till later because of their IHT protective benefits. That's not a one-size-fits-all solution. It absolutely may be right for some people. But we also have many clients that currently draw down from pension for different reasons. It has to be put into the mix, but it's never been a one-size-fits-all that ISA should be drawn before pensions, because that is really too focused upon this sole point around IHT. I do think that pensions should be considered more heavily in the context of where we draw down from now. Absolutely.
Thank you. One that perhaps I'll start with you on, Andy, and then Andrew can chip in with any further thoughts he has. From a tax point of view, is it better for me to access more of my pension now and put up with the increase in tax, or leave it for my children and let them have the tax burden?
So potentially, I mean, it depends all about what your position is. So, what's your marginal rate of income tax now? What is the potential for your children to pay income tax? I think also around the tax point, I've noticed a few questions, just a bit of clarity around the risk of double taxation. I think it'd be good just to cover that quickly. So, there's people worrying about the fact that their pension will be subject to IHT, and then after that also income tax on the same amount. There is rules being brought in to stop that double taxation, and to think of it, to try and put in a sort of a very simple example. If you have £1 million of pension pot, when the new rules come in, that will be subject, based on the fact there's no other release, no rate band's been used, etc. There will be 40% IHT on that pension pot, so there'll be £400,000 tax to pay. Of course, the estate has to decide where it takes the money to pay that. So you could, at the end of that, the IHT liability of £400,000 on that pension could have been paid from elsewhere. So you still have a £1 million pension pot left. A credit is available for when the drawdown happens, that when the beneficiaries do draw down for income tax purposes, as the legislation stands now, there will be a credit for recognising that actually that £1 million IHT has been paid on that pot. So you're not going to be double taxed on that £400,000.
That's great. Thanks, Andy, for the clarification. We have another question around the 25% drawdown. So a widow who's left her husband's company pension, can they still draw down the 25% if the late husband did not make that drawdown?
Generally speaking, no.
Yeah. Okay. So sorry, just scrolling down a little bit. A couple on surplus income in here. So does surplus income include 25% tax-free drawings?
Sorry, I just missed that, Suzanne.
Does the surplus income include the 25% tax-free drawings?
So this has been a bit of a debate. So there is opinion out there that yes, you can do it as long as you plan it properly. I think, unfortunately, these things are often tested by HMRC, and if the extreme the courts after these things have happened, and so anybody doing this at the moment is new territory. But broadly speaking, we think that as long as you take out the 25% lump sum, the analysis is that is an income withdrawal, and therefore if you make stage payments or gifts out of that, it will qualify. I think there is grey area and a spectrum here in terms of if you're drawing down a 25% lump sum and then paying or gifting, that 25 lump sum in one go. It is questionable whether you're going to meet that exemption. But in broad terms, with the right planning, yes, we believe that the 25% lump sum used properly can qualify for that exemption.
Thank you. Another question while we're on the subject of surplus income then, can you include income earned from capital? So for example, interest within that surplus income bucket?
So as long as that is income, yes. So broadly anything that would, for example, you including your tax return and is taxed, therefore as income, that income can be gifted as long as it is surplus to your requirements.
And is there any particular recommendations you have in terms of evidence you need to support that position that it is surplus income?
So
questioned.
So it's good to have maybe an accountant track it for you. There's also HMRC forms that can be used to track those sort of gifts, so that because a lot of this planning is also to make sure that unfortunately the people who have to deal with the IHT aren't around, so you have to make sure that things are in place so that your people who manage your estate can look at these forms and see that things are done properly and track back and do the necessary filings at HMRC. It's all about good planning. In terms of, I think, what some of the questions have been around regularity. So you have to show that these are regular gifts. So the most obvious example would be a bit of a pocket money for a child at a surplus income. Obviously, for the numbers we're dealing with, talking about larger regular gifts. These can be annually if needed, but they have to show regularity, and it has to be out of surplus income still. Generally speaking, I see clients do it broadly, either a monthly or a quarterly fashion, or 6 monthly. But the key thing is get advice to make sure that they will qualify as long as you do it properly.
Right, thanks, Andy. I think this next one maybe is for you, Andrew. Is there a difference between how a defined benefit and a defined contribution is treated?
Yes, there is. A defined benefit typically isn't an unspent pot of cash. It provides a regular income to the scheme member. So yes, there is fundamentally a difference. And what we're looking at here relates to defined contribution, unspent defined contribution pots of money in pensions that will be added to the estate calculation. Any other scheme needs to be looked at individually in accordance with the scheme rules to determine exactly what it is and how the interaction with the new legislation exists. So you would need to look at that on an individual basis. But what we're looking at here is defined contributions as a wholesale concept rather than defined benefit pensions.
Thank you. We have had a question about defined benefit pensions and the valuation of them for IHT. I don't know if that's something that you could comment on.
I think that's too specific for this today.
That's fine. That's fine. I'll take that offline. So we've had a question around AIM shares. So would AIM shares held in a SIPP be appropriate to avoid being caught in the estate for IHT? You might think that's a bit specific as well.
It probably crosses the two of us, actually. Do you want to start, Andy, because you're smiling there?
I think that's incredibly specific. I think that would need careful consideration about what would be the actual IHT position of doing that.
Yeah, very good.
Conscious
of the time, actually. And we're on 29 minutes past, so I feel like I've probably not got any time for more questions, but thank you very much, everybody. Firstly, thank you to our speakers, Andy and Andrew. Great session. Certainly, I've learned a lot. And thank you, everybody, for your participation and your questions. To the extent that we've not answered them, we will follow up directly with you, and we'll be in touch. And we had a few questions around the slides and the recording, which will both be shared straight after this. So hopefully they will be helpful as well. And everybody's details are on there. So should you want to get in touch with anybody directly, you will be able to through that. And on that note, I think we'll draw it to a close and once again say thank you very much to everybody and have a good afternoon.